What's the dealio, y'all? So look, man, we got a jam-packed video today. Y'all been blowing me up in the comments about 0DTE, strike prices, expiration dates, all of that stuff, right? So I'm gonna go over everything in this video, all right? Before I get started, I wanna say please like and subscribe on this channel. I appreciate all the love. We at almost 500 subscribers. Okay. Next thing is I'm going to be launching a Discord in the next couple weeks because y'all been asking me about one-on-ones and stuff like that. So I'm about to launch a Discord. We're working on that. So if you want to get access to the Discord before anybody else, drop prosperity in the comments. And then when I drop it, I'm going to respond to that comment. Okay. So we're going to go over strike prices and everything. So I like to make this very simple, very simple. So I'm self-taught with options. I didn't go to school for finance and stuff like that. So I'm self-taught, right? So I try to make this very, very, very simple. So I don't try to overcomplicate it and give you all these jargons and stuff like that. So the first thing, we're going to go over everything and then I'm going to share my screen. So strike price. First things first, strike price. So your strike price is, where do you think your strike price is basically like a foundation of your option contract, okay? So you have something called, so if the stock price right now is at $50, any stock, the strike price is, you could get a strike price of $55, $80, $70, whatever the case may be. I'm gonna share my screen in a second, right? But the strike price is that. And then you have in the money, you have at the money, you have out of the money. In the money is anything inside of that stock price. So what does that mean? If the stock price is at $50 and you think the stock is going to go up, anything below 50 is an in the money contract. Okay? Anything above that $50 is an out of the money contract. Okay? And then same on puts. If you think the stock is going to go down and the stock price is at $50, anything above the stock price is in the money on puts and below it is out of the money on puts. Okay? So always remember, wherever the stock is going away from is in the money because it's already there. And wherever the stock is going towards, that's out of the money. The stock is trying to get to the strike price. Very simple, okay? Very simple. Day trade, swing trade, it don't matter. These are all very, very, very simple things. So that is the strike prices and in the money, out of money. Now, I'm going to pull up my screen and I'm going to show you exactly what I mean, right? So we got, all right, boom. So right now, this is my Weeble, right? So let's say we got Palantir. So we're gonna go to the options chain. The option chain is where you buy your option contracts. So you could click on that top right there, or you can click on options and it's gonna take you to the same screen. So as you can see, the stock price right now is $73.30. On the left side is calls, on the right side is puts. And it doesn't matter what brokerage you're at. Robinhood looks a little bit different, but all the other brokerages, they're all the same. So left is calls, right is puts. The top left is in the money contract. So you see the stock price is $73.27. Anything below $73.27 is an in the money contract. Anything above 73 is an out of the money contract. 74 is like at the money. And then on puts, if you were going to ride the stock price down, anything above the stock price is in the money and anything below the stock price is out of the money, right? Because if you're on a put and you get a strike price of, let's say, $76 right here, right? You think that the stock is going, a stock price of $72 right here, you're going to, you think that the stock price is going to get closer to $72, right? So that's in the money and out the money. It's more risky to get an out of the money contract. It's a lot safer to get a in the money contract because the contract is going to hold its value more. And we're going to get into that in a second, right? So we got the strike prices. I hope that this is making very clear sense. We got the stock prices, the strike prices. We know where the stock price is at. And then we have the in the money and the out of the money contracts and the at the monies, right? I hope you tracking. So now the next thing is your expiration dates. If I'm day trading and it's Monday, Tuesday, Wednesday, and sometimes Thursday, my expiration date is going to be the Friday of that week. Okay? So right here, you got January 24th. That is this Friday. So I'm going to get the Friday expiration calls. And I personally like to get in the money contracts when I day trade. And I'm going to tell you why in a second. It's because of the delta. That's the Greeks. So if I'm day trading, the first half of the week, I'm going to get these, I'm going to get the Friday expiration dates. It's that simple. It's that simple. So all you can do is you go here, you go to options, and Palantir's at $73 right now, right? So if I want to get in, I would go to 72. Also because these are cheap. In the money contracts are more expensive than out of the money contracts because it's already expiring. In most likely, it's already going to expire under the stock price, right? So I would go here, and then I would execute my contract, however many contracts I want to get, right? And then it's going to tell you how much it's going to cost. Now, let's go to the delta, the Greeks, right? So you got something called Greeks. The main ones I pay attention to are the delta and the theta. The delta is basically the profit potential of this contract. So here's what I mean. So when you are on Webull, all you do is take your thumb and you scroll to the right. And as you can see, you got delta and you got theta. And also, so look at the top left right here. In the money, how much in the money is this contract? This is the percentage. The theta and the delta. So on all these option contracts, you got on the calls on the top left, you got calls and you got delta and theta. So the theta, let's start with the delta. The delta is the profit potential. So when you buy it in the money contract, it's more valuable because when you sell your option contract, somebody else is buying that contract and they might be buying it to exercise the option to buy this contract of those 100 shares at that price. So if I have control of 100 shares of a stock and I buy control at $70, but the stock right now is at $80, that premium is going to be higher. So that's why I like to trade in the money contracts and the delta. So when I'm day trading, as long as the contract is in the money, I will trade it. Every now and then I'll do it out of the money, but that's only if I'm being cheap or if I really, really, really know like this is going to go fast. If you're doing out of the money contracts, you have to ensure that the move is like happening or it's literally like seconds away from happening, because if you don't, then the theta is going to kick in. So before I go into that, on a day trade, as you can see at the bottom, this last in the money contract is that the delta is 0.53, which is basically 53. That's how I look at it. So it's at 53. This will hold up solid. Now, a lot of times what people do is they will try to trade a strike price of, let's say, $78, and that delta is only 15, okay? Which means that its profit potential is less, okay? It basically lets you know how much is this stock gonna go up. For every dollar that the stock goes up, how much is this contract gonna go up? Because you gotta understand, options are a derivative. So options derive from the stock, okay? So everything that's going on in options, it's derived, its value is derived from what the stock is actually doing. Boom. So now we got the theta. The theta is how much is this stock going to decay? Now this is where it gets tricky, and this is why you got to know what you're doing. Because if you get an out of the money contract, let's say you get a strike price of, let's say you get a strike price of $80, it will decay way faster than if you get a strike price of 71. Okay, so I keep it simple. I keep it very simple, right? Delta's profit potential, theta is decay. That's why I trade in the money contracts, because sometimes you may think that the stock is going to do something and you're going to be in and out, but you end up not being in and out. You got to wait a little bit. You got to be a little bit more patient. The stock goes like this, and then you get out the trade. You think you're making $400 and you only end up making $200 because of the decay, right? So you have to understand and know. That's why for me to keep it simple in my mind, I trade in the money contracts. It's that simple. Just hear me out. Listen, it is that simple. Okay. So let's say it's a day like you get in a trade, your entry is a little early. Let's say you get in a call, your entry is early, and then the stock drops a little bit and you're just waiting because you know it's going to go up. If it takes 3 hours for the stock price to go up, your profit actually ends up being lower than what it would have initially been because you got an out of the money contract. In the money still may be a little lower, but it's going to hold its value a lot more, which means that's why I like to get in the money contracts, right? It's just a protective mechanism for me. That's all it is. Once again, I like to keep it very simple. Now, what is those are the two Greeks I pay attention to, the Vega and the Rho. Those are like sensitivities. So the Vega is like a sensitivity. What's the sensitivity to the implied volatility? And then the Rho is what's the sensitivity to interest rates. But honestly, me personally, I be in and out of these day trades in like 3 minutes, 2 minutes. So I don't pay attention to those ones right there too much. On Webull, as you can see, it does not show the the theta or the Vega and the Rho. Okay. Also, let me give you one more. This is a bonus right here. So let's say you want to get the strike price of $73. When you are buying your call or your put, you got order type, you got limit, you got market order, stop limit order, group orders, all kind of stuff. Limit order is how I buy my things. And right here, you got bid, mid, and ask. Okay. Never buy at the ask. Always buy closest to the bid. All right. You're going to get the cheapest price in this spread right here. Right. And also don't buy market order. Don't buy market order. Sometimes you may have to, but do not buy market order. Unless you have to, and you know where the stock is going. Because if you buy market order, it's going to get filled at the exact spot where the market is at. And so it could be way higher than what you want it to be. Okay, so you could buy it at market, get in and be down $150. It's happened to me before. It's happened to a lot of people that are beginners before, right? Also, I try not to sell at market unless I have to, unless a stock is just going crazy down or crazy up. And the reason is because you think you're going to make $400 and then you end up making $270 because you sold at market and not the limit order. So make sure you buy at limit and you buy closest to the bid and you sell. I usually sell around mid because if I try to sell at ask, depending on the stock, it probably won't fill unless it's continuously going up. So don't be greedy, but like you got to know how to get in and get out. All right. So that's a bonus right there. Now we got 0 DTE. What is 0 DTE? We're going to go to the SPY. The SPY is at, we go option contract. So the SPY today is January 31st. Right now, this expiration date on these contracts is the 21st of January. So that's a 0 days to expiration, right? So what this means is if this play if this call or put doesn't happen like today and you don't get in and get out, you are going to be asked out of money. Okay. So me personally, I don't like trading 0 days to expiration. Some people love it, right? But you could make good money on it if you know exactly what you're doing, but also if you like trading the SPY or like indexes. I personally, I'm not a big fan of trading the SPY, okay? Because I don't like how the SPY moves. That's just me. Everybody, remember this. When you're trading, everybody got their own styles. Everybody got things they like, they don't like, etc. So that's just me. Okay, so that's 0 days to expiration. So we got in the money, out of money, and at the money contracts. We got the strike price. We got the expiration dates. We got the deltas and the thetas and the 0 days to expiration. When it comes to strike prices, if I'm getting into a swing, like let's say that I wanted to swing, it don't matter. Let's say I wanted to swing Shopify. The stock price right now is at 106. If I wanted to swing Shopify, I haven't looked at the charts or anything. I'm not going to, but I'm just giving you an example. Depending on where the price was at, what the targets were, I might do February 21st. If the stock price right now is at 106, I would get in at, let me look at the deltas first. I would get a strike price of like $100, 100 or lower, because the delta is 67. And that means that my profit potential is way higher. And so for every dollar that the stock ends up going up, I'm going to end up making more. So in the money contracts are more expensive, but you're going to end up making more. Out of the money contracts, you have to make sure you know what you're doing, because the slower it takes that stock to get there, your profit is going to be less. Right? So that's why sometimes I'll day trade. I'll be in a trade for like a minute and a half, 2 minutes, and I could be up $150, $200. And sometimes I'll just get out because it was an in the money contract and it's more valuable, right? And I wasn't in the trade at all, basically. So I'm like, I'm gonna take my profits just like that. Okay. So yeah, that is strike prices, expiration dates, delta, theta, the Greeks, 0 days to expirations, buying a contract, limit orders, market orders, all of that. I don't mess with market order like that. It's fucked me before. Every now and then it might save you. If you're in a bad trade and you got to just get out, then get out at market, because it will get filled. If you try to do limit, you won't get filled. So sometimes market does work, but it just be tricky sometimes. Okay. So I like to keep this simple. Remember, I like to keep this simple. I don't like to overcomplicate this stuff, right? It's already complex as it is. If we could make this simple, we could make more money, right? So I hope that helped. Be sure to like this video, subscribe to the channel, and I'm gonna see you guys tomorrow on the next video. Always remember, get out of your head and get into the world, because your head is a dangerous place to live. All right, I'm gonna see you on the next video. Peace.